Hey guys, welcome to another Trade Genius podcast. Philip with Bob here as always. A really important one today. We got to talk about this huge derivative bomb that's in the system. $65 trillion poses a massive risk to the entire global financial network. So let's learn about it in this video. Let's dive in.
Trade Genius.
So Bob, can you take us through what this issue is here with a $65 trillion in debt that's a concern for our global markets?
Yeah, I apologize. I kind of misplaced my piggy bank. And so, look, first of all, I hate when they use the word missing because it's not missing.
No.
Okay, somebody knows where it is.
Yeah.
Okay, let me translate for you. It's somebody really important and they're politically protected. And if somebody found out who they were, they could take down the entire global economic system. So, what is the risk that they took on? The only thing I could think of, Phil, is that somebody is trying to absorb all this dollar bullishness and is shorting the dollars in a naked way because they have no collateral against it. They're afraid the dollar is going to go up. So I don't think it's the other way around. I think they want the dollar to go down, so they wouldn't be putting themselves at risk that way. So I think it's a naked dollar short position that has them hanging out by, $65 trillion. I mean, that is mind-boggling. There's no way they can cover it.
No.
And if they find out who it is, and look, the Fed, and I think part of this is I think this got leaked by the BIS to Bloomberg to scare off Powell, to keep the dollar from getting stronger. That's kind of my view of it. So I like maybe to hear maybe what you're thinking about that.
Yeah, I mean, obviously, I've always pounded the table that there's way too much leverage in the system, and every time, and that's part of the reason why the Fed can't really truly walk away, because every time, and we've shown this on previous videos, but the liquidity, right? Every time they try to give the market a chance to stand on its own 2 feet and remove liquidity, the market gets very unstable and you have these like sharp reactions to the downside. And it isn't until the liquidity starts coming back in a meaningful way that you see stability come back in. And then this kind of, what people refer to as the fake market, where it just kind of just melts up on low volume, right? But it's all that Fed liquidity coming back in. But until we get like all of this out of the system, like right here we have this slide up and it's talking about how there's $39 trillion of this like black hole debt that's hard to account for. And what's staggering about that is it's more than double their on-balance sheet obligations and 10 times their capital. I mean, you're talking about scorched earth here in financial terms. And that's why I think ultimately at the end of the day, that's the dirty little secret in the room, and why the Federal Reserve and all of the other central banks ultimately will have to keep printing, because this is going to keep coming up. And I really don't know what, they should have told these guys, these counterparties, that, hey, look, you're going to have to get rid of all the leverage in your books or we're not going to do business with you. You can't come to the Fed window overnight, blah, blah, blah. And they never just do that for whatever reason. And this amount of derivative leverage in the system hasn't gone away. I mean, it was part of the reason why we crashed so hard in 2008. I know it's why we crashed so hard in COVID, because it just creates, every time someone runs into trouble, it just creates a domino effect. FTX is just a small sample of how that happens. You can't meet obligations. So in this situation, you've got all these trillions of dollars. I think they said overnight at any given time there's $2 trillion. All it takes is one counterparty to fail to redeem on one of these swaps, and it's going to create a cascading domino effect. So the Fed, although they're being aggressive with the fight against inflation, they're also putting a strain on the system. And it's interesting that they've been as aggressive as they have been, because I'm assuming they have a pulse on this, unless they don't. And like you said, this is why it's coming out now, that there's basically a red flag being flown here and saying, hey, if you're not listening, you should be listening now, because you're on the brink of something very terrible here. But this is where we wake up one morning, or our alarms go off overnight, and things start breaking over in Europe. And I personally, I have a feeling that's what's going to happen on the next big cascade. It's going to be European based, and we're gonna wake up one morning where we gapping down 200-300 points on the S&P 500.
Yeah, I think, if I can, let me try to explain to people in the most simplest terms here. Since we lost the desire for sound money in the political class, which they never like sound money because you can't buy votes with sound money because sound money has to be earned. But credit money doesn't have to be earned. It could just be created. And so we're at a point now where the system requires constant infusions of credit, to keep the system from imploding on itself. And really, we're almost at a 9-to-1. That 10 times issue is kind of ironic because if we had to implode the system back down to nothing, Phil, we're looking at probably assets are worth 10 cents on the dollar worldwide.
Right.
Okay. If you have to get down to what's called base money, right? So base money has been rehypothecated probably 9x.
Right.
And so that's why I always laugh when people say, "Oh, Bitcoin's a fraud, gold's a fraud." Well, guess what? When the fiat regime collapses down on itself 91%, Bitcoin and gold are outside of those situations.
Right.
Okay. And I mean, if you own great farmland and stuff like that, you still have to have access to cash to be able to buy, the grains, the seeds, the fertilizer, the equipment, and the people. So it's going to be really. And look, at some point it can't continue. We just don't know when that is, and that's why you always hear the word the Great Reset. These guys are acting like they're in charge of the Great Reset. Well, physics is in charge of the Great Reset, and we just don't know when that's going to occur. But this is pretty interesting.
Yeah. In fact, Bob, maybe we flash over to the dollar chart because I think it's at an important point here. Let's switch over to that real quick. So this is the dollar DXY index, and if you aren't sure what that means, it's just like they take a basket of things measured against the dollar, the euro, the pound, things like that, and they come up with the dollar index. But if you'll notice, though, we're at a level now here. Let me change my cursor to something you guys can see here. All right, so we're at a level, if you guys can see this, where we're at a big weekly. This is our Ranger buy zone. If you guys want this indicator, tradegenius.co, you can get this. But we're at a point where not only are we hitting that, but we're also hitting on the chart just some structural support. And this can generate quite a big bounce. We warned about this falling out of this parabolic curve and driving the markets up through the midterms, and now you've seen it even extend through the midterms into the first week of December, which seasonally is to be expected, but also seasonally is where markets tend to exhaust, and especially in a midterm year. And so we're actually looking for this to bounce, and this could bounce significantly. And then what Bob's talking about, where the dollar bounces, that's going to put a huge strain on these things, and these derivative bombs are under a great deal of stress. So this isn't a time to be complacent by any means in the market. We could see quite a big sharp reversal actually as we make another bear market high, make a lower high, and then come down. And what that means is we're probably going to test the lows. So very pivotal spot here going into next week's Fed rate announcement. And typically there's a move either up or down into that announcement. There's really no rhyme or reason from one announcement to the next what that move is. But if you start seeing a move in a direction to that announcement, which is not this Wednesday, but next Wednesday, you can assume that that's probably going to continue. So
yeah. And if I can interrupt you, Phil, just so everybody knows too, Phil and I do our podcast a day ahead, and so you're seeing this on Tuesday, but on Monday early, we've noticed the dollar and the 10-year were hitting the support areas, and if you notice, the market just had basically a massive, I want to call it a meltdown or a sell-off. It was basically a no-bid market. Wouldn't that be a fair way of saying it?
Yeah.
And that's because these guys see the same thing we're seeing. Big money's seeing this. What we don't want to have happen with the dollar is we don't want the dollar to make a new high at this point. So we want that Sornet wave, that hyperbolic move on the dollar, we want that to fail without making a new high, because if it makes a new high, I think that's what blows up the derivatives, Phil, be honest with you. And And then obviously if it makes a new low, it's a different problem. So a different set of players get crushed when the dollar falls versus when the dollar rises. But I think if this is a non-U.S. bank, the bet is that they've been shorting dollars, and they're going to they're feeling the pain right now. They had a bit of a relief. I think they're worried now with before this leaked out before the Powell meeting is probably to a shot across the bow, basically saying, "Hey, you're going to blow up the whole system if you do this."
Agreed. And I think we were debating this in the room earlier, but I think don't be surprised if you see some just wild dollar move here that challenges the early 2000s high, which everyone thinks, oh, that's improbable. I actually don't think it is improbable. I think we could go chase and then see like an attack on 120, which is that's going to be pretty bearish for everything risk on, but not I think the yield curve's telling you that. I think if you guys watched our previous videos, the Fed pivot coming, it could play into that easily. So don't be surprised. Get your heads wrapped around the fact that we could be heading for some lower lows here as we progress into 2023, and then you're going to have like great opportunities. I think if we do ring the bell up there, I think you're going to be looking at some awesome deals on some long-term stock holdings, and even like the stuff that Bob talks about, his stock picks that we do every week, those short little videos. I think you're going to see tremendous opportunities in those long-term plays that Bob picks out.
And just so you guys know, just a not so humble brag here is that check out the ones we put out for you guys. We put out steel stocks that pop. We put out shorting Target, it plunged. Go check our stock picks out, guys. I'm giving them away for free. Okay. These aren't, I'm not throwing dartboards at this stuff. This is all math for us. And we want to put you guys in a position of success. We put people in UDOW first thing this morning, and people are walking out with some nice trades, puts on UDOW, 18-20% one day returns on a nice trade. And so, check us out. And if not, tell your friends about the blog. I'm happy to do it for free if we have enough people watching this stuff over time. So we know what we're doing here.
Yeah, so Bob, I think what we're going to probably end up doing in the market here is potentially round tripping this Powell pump, and then we'll see. I mean, there's some decent support in this area. We could potentially stay somewhat range bound in this, but if we start losing this Powell pump, then we start looking at going deeper, maybe even back to because as you guys may or may not know, if we kind of look at the weekly 9 EMA, and if we start losing that, which is a little lower here, then that's really like risk off. That's when you need to start rehedging your portfolios. Above the 9 weekly in a bear market, you can take the hedges off, but under it, again, especially if you get a weekly close under that, that's very bearish, and that's going to cover everything, crypto and metals and all that stuff. So anyway, that's kind of where we're at the moment until we get some resolution on the Fed rate hike, which we're expecting 50 basis points. If they do anything more than that, this market's going to crash very, very quickly. 50 is expected, and I just think we may have gotten an early December Santa rally, right? And then and it's petering out potentially here. So just be on your toes.
Yeah, and we'll talk maybe later this week. We'll throw up the chart, volatility charts. We should talk Treasury chart too, Phil. Janet Yellen basically drained our Treasury. There's a lot of things that are not setting up for a bullish end of the year. So, even though people might be expecting Powell to slow the rise, they're using up all the seed corn right now, and so it could be a bumpy year end for everybody.
Yeah, and to the point of VIX, which is volatility, if you guys notice, when we do end up getting back into this daily buy zone, we typically get a rotation. And these have been coinciding with our bear market rallies that have been topping out and then dumping again. And as you can see, we're overdue. And most likely we're going to see this thing rally at least back up to this sell zone. I'm personally a little more bearish. I think we push up higher and we actually make new lows in the bear market. But just to put another perspective on this is the VIX, the volatility is way overdone to the downside and should rotate back up as well, which is inverse to the market, means the market will go down. So there's some perspective for you guys as we move forward. But yeah, so I think this is all going to be, especially with when you have the $65 trillion of derivative bonds sitting under you. This isn't a great spot for the markets, and the Fed, if they're not careful, they may have to come in, and you're going to get not only a cut, or a pause, you're going to get big cuts too, because it'll be the same situation as COVID. If this gets disorderly, which it can very quickly.
Yep, I agree. And guys, thanks for listening, and hit subscribe, tell your friends. Phil and I, we're starting to really get into doing these podcasts. So, we hope you guys are enjoying them, and let us know in the comments anything else you want us to talk about. So we're at a point now where we thought we wouldn't have anything to talk about. We'd run out after a couple weeks, and every day we could probably do 10 videos today of all the stuff that's going on out there.
Yeah, pretty volatile environment. So we should have a lot. It should be an interesting week. So thanks, guys. Thanks for watching. We'll see you on the next video. Take care. Bye-bye.
Trade Genius.